Welcome, everyone. My name is Stephen Halasnik, and I'm co-founder and managing partner of Financing Solutions. Financing Solutions is a leading provider of lines of credit to small businesses. Our line of credit program is fast, easy, inexpensive, and costs nothing to set up, making it a great cash backup plan for your business. If you'd like to learn more about our line of credit program, please visit us at fscreditline.com. Again, that's FS as in Financing Solutions, creditline.com, or give us a call at 862-207-4118. Just remember, the time to set up a line of credit is when you don't need it. So when you do need it, you have it there. And I would tell you, there have been a few times in my career over 25 years when I was either one, very happy that I had a line of credit in place, or two, made a mistake of not having it in place, ready to go, and I needed it. In fact, one particular time, I actually got lucky and I had to reach out, and I was going to be short on payroll, and I reached out to my line of credit and found out that it had lapsed. And then the bank told me it was going to take 2 months for it to get it back in place. So, keeping a line of credit in place, regardless if you need it or not, is always a smart, good business decision. Today, I am excited to be speaking with Chris Saxman. Chris has more than 30 years of experience as a serial entrepreneur, financier, and a C-suite executive with an extensive background in funding, founding, building, and investing in companies, raising capital, and developing and implementing corporate strategy. Currently, he serves on the board of directors of Nimble Science and is an active mentor for Techstars. Previously at Cirrus MD, a leading telemedicine firm, he was instrumental in developing new value-based business models around virtual care for large payers, employers, and integrated delivery networks. Before joining Cirrus MD in 2014, he built 2 tech-enabled startups in New York City. He also has extensive experience investing in tech startups through AIG's private equity arm, New York Angels, and Rocky's venture fund. He's a leader of the digital healthcare community in Colorado and nationally. He received an MBA in finance and economics from the NY Stern School of Business and as well as a BA in economics and government from Cornell University. He lives in Louisville, Colorado with his wife, young daughter, and Australian Shepherd. Chris, welcome to today's Entrepreneur Podcast.
Thank you. I'm very happy to be here.
So this is a fun podcast for me, and in that, a number like 10, 15 years ago, I was involved in angel funding, doing, looking at companies. And, I also, talk to a lot of young people. And, the number one way that they think that they need to build their companies is based on angel funding. So today's topic, how to raise funds from angel investors and venture capitalists, is going to be a fun topic to kind of talk about. So Chris, the first thing I just want to kind of ask you about is, what type of conditions you think need to exist in your company in order for you to be looking at angel investors or venture capitalists?
Yeah, no, that's a great starting point. And I think so. The first thing I'll say is not every business should raise venture capital or angel funding, and furthermore, there are businesses that make sense for angel funding, but not necessarily for venture funding. So you have to understand, in general, when you're looking at financing your business, what sort of business you have, and understand what the appropriate financing mechanism or mechanisms or vehicles are for that business.
Yeah. Oh, sorry, go ahead. Finish.
No, I was going to sort of dive into what might make sense for those that do want to raise angel or venture funding.
Yeah, we'll get that in a little bit. Let's just start off because I think a lot of people don't know what angel fund. So let's start. You're an angel funder yourself, right? And I think a lot of people who have businesses that are relatively new, or even if they're not new, or they're not familiar with angel funding, they don't quite understand what an angel funder is going to look for in order to do a deal. So I mean, when you're looking at a company that you are potentially going to invest in, what is it that you're looking at to see?
Well, I think that the first thing you have to ask yourself is this business scalable? One of the there is a great definition of a startup, and that is that it's a temporary collection of people who have come together to discover a scalable, repeatable business model.
Yeah.
And I think angels are looking for those sorts of businesses. Now,
Yeah.
if it's a business model where or if it's a company where the business model is well established, a new retail store in Main Street, for instance, and you kind of know what that's going to look like. It's the business itself might fail, but the business model is kind of what it is, and you kind of know what it's going to look like. That's probably not something that most angels would look at least not the type that I associate with. But on the other hand, if you've got a company that's trying to develop a new software as a service platform for a small niche in the economy where everything's still done by paper, for instance, and believe it or not, there's still lots of little niches like that out there. And you can make an argument, or the entrepreneur has a vision as to why this software platform is going to revolutionize this little niche, and maybe that niche is a $1 billion industry. Now that is angel fundable.
Yeah. Yeah. I mean, and the reason for that, and you could kind of help me with this because this always confused me a little bit. But I know one of the biggest reasons is that in general, angel funders just really don't make their money until there's some type of exit, or someone comes in and buys the company, or a VC comes in and takes out the angel funders. There's got to be some type of event that happens that allows you as the funder to get your money back out of the business. Is that accurate?
Yeah, that's what most angels. That's what again, at least the angels that I look at are looking for those types of deals where they're playing. This is not a cash flow play for them. They're not looking for a profit share. What they want to see is that the business is going to go from $1 a share in value to $10 or $20 a share in value over the course of 5, 7, 8 years. And they're going to make 10 to 20 times their money.
And there's going to be a liquidity event that, there's going to be a sale, or someone takes you out, or something's going to happen, or you're going to merge with other companies, you're going to make a bigger company. There needs to be something like that. Now, that this is the problem I never really quite understood. I kind of thought I understood, but I wasn't really sure. And that is, suppose you have a business that's, it was an angel funded deal. The company gets up to $15 or $20 million in revenue. There's no liquidity event that happens, that, no VCs are interested in it. The company's making money. They're making, let's say, on a $10 million, they're making 1.5 million a year, right, in profit. Does the angel participate in that profit?
Well, so these are typically angels would invest in companies that are structured as C corps. And it's in other words a standard corporation.
Yeah.
And that's a fairly typical requirement to raise this type of capital, that the company be structured that way. So in that scenario, just like any publicly traded C corp or any other large, well-established family business, say, you could pay dividends, and the company could pay dividends. But and that's how ultimately, I guess, the angels would participate. But I would say that most companies that are of the mindset that um, that attract angel investment in the first place, they
Yeah.
take that 1.5
Yeah.
million in profit and
And put it
reinvest.
back in the company.
Yeah, so
Yeah.
there would
Yeah.
never
They
be
say
any.
do something with it.
You'd be out
Yeah.
hiring people. You'd be like, okay, how can I get to 20 million in revenue? And
Yeah.
if you succeed in going from 10 to 20 million in revenue, you're going to get attention from people. So if you have that success, um, you might be bought by a larger company. We've all heard about Facebook buying everything under the sun, or Google, and you know, uh,
Yeah.
that's a common exit technique. And then, the VCs typically wouldn't take out angels. They would want their money to go back into the business. They'd want the angels, they have no interest in paying out angels. They just want, they're investing.
Oh,
They want their dollars to go into growth as well, because that's how they make
oh,
their.
I got you. I didn't. Oh,
Yeah. So, there
yeah.
may be
Yeah.
deals, later stage deals where, maybe if you've done 3 rounds of venture funding and the fourth round comes in, it looks more like private equity. They may take out the angels, but generally
Yeah. Yeah.
the angels are in for the ride, just like the VCs, the full ride.
Yeah. Well, I guess if a VC is going to come in anyway, it looks that's a promising sign for the angels, and they're going to see a bigger payout at some point, potentially as well. I mean, a VC, if just to go back to my business school days, a VC comes in, they want to see a company go public, they want to see a company get bought, or they want to merge a whole bunch of companies. So they're looking for even bigger plays. Is that accurate?
Well, they're looking for the same plays that the angels are looking for. The angels just get in at an earlier
Earlier
stage.
stage.
They take more risk, but because they got in at an earlier stage, a lower valuation, presumably their payout will be greater, but they'll also invest in more losers probably than the VCs will,
Yeah, yeah.
because they're earlier on and you just don't know how it's going to play out.
But before we get into like your methodology of going from becoming a company and angel invest, working with angel investors and that whole process,
Mm-hmm.
have you ever seen a company that you said, that's a nice little business, and that guy, that company can do okay, but they're never going to be a big player, but I think I might want to invest in them anyway, just because I would, I want to get, I don't want to say the dividends, but I want to start getting money at a cash flow basis. And I know this company might do it. Do you ever do stuff like that?
No.
Yeah.
But to be clear, the one thing I should say, Stephen, is that there are hundreds of thousands of angel investors around the country. There may be thousands of VC funds, but there's hundreds of thousands or millions of angel investors. And there's plenty of them that make those types of investments that are, and I think a lot of it has got to do with where those angels made their money, the type of mindset from which they come. I mean, look at Shark Tank. We all watch Shark Tank in this business, and those guys are always talking about, hey, I'm going to make you a loan. I'm going to get, X% of the profit. And a lot of those types of businesses and so those are all angel investors. I mean, they're those are real live deals you're hearing there. Those are actual angel investments with
Yep.
real money flowing. That's not
Yep.
fake. But the types of businesses that go on Shark Tank are those that are generally consumer focused, where you're building a product that might do well and might get to profitability pretty quickly. So those types of deals that those angels are structuring may well indeed have profit sharing potential, and that's how those guys are looking to make their money back. And I've certainly there's a lot of guys that are real estate, make their money in real estate, who come at angel investing with that type of mentality. Let's invest in businesses, and I want to get some profit out of it, right?
Yeah.
Whereas guys like me, we're always looking, like I'm at heart an entrepreneur, and so I'm not looking to build a profitable, nice little profitable business that'll generate some cash flow for me. I'm looking to make my money on the ultimate exit. And so it's neither one is wrong. And that gets back to the point I made at the very beginning, which is you have to understand what type of business you are as a company
Yeah.
and
Yeah.
get the right type of investors for that company. In other words, if you're trying to build a little, consumer facing widget that, could sell a lot of product, but it's not going to become a massive company per se. But the product, well, go on Shark Tank and get one of those guys to back you, but don't expect to get venture capital because they're not going to, the venture capital folks want, how are you going to get to be $1 billion business? Not billion in revenue, but billion in valuation, worth $1 billion, a unicorn. And angels. And so if you don't if that's just not what you're trying to do, or the business idea you have is just not going to make no sense, then don't bother going to VCs. You'll just be wasting your time. Now there's a third category in between the companies that belong on Shark Tank or something like that, where they're going to build a nice little profitable business over time and share profits with their investors, and the guys that want to go out and build the next Facebook. What about a company that is building a smallish software product that's never going to be a billion? It's just like I know a company here in Denver that's building it's an ed tech company, and they're building a music training program for children. Now, that's never going to be venture fundable, probably. However, I could see somebody coming along and buying it for $20 million if they're successful. So if you're an angel investor, so that might be a company where if the angels were to get in and say, $3 or $4 million, put some money in, and then sell it at 20 or 30, they'll still do very, very well for those, that small amount for that early stage investment. And whereas, so it's no more venture fundable than is the Shark Tank company, but it could be angel fundable by angels that want to return, like an exit, not a cash payout over time. And that's, again, if that's the type of company you have, then look for angels that do that, but just know that's probably your source of funding. You're not don't go bother to try to raise venture funds after that.
Yeah, I was telling Chris before we got on air, because Chris and I had met a long time ago. We were trying to just determine, how we knew each other, and I was telling Chris that my business partner and I, we were involved in angel funding. We were looking at lots and lots and lots of deals over a 3-year period of time, and we ended up not going that route. But what we ended up doing, years later, is we were studying all these different spaces to kind of potentially look for businesses in, and we came across this one area of companies that were buying life insurance policies when people pass away, and they would provide the money to the families up front and then collect the money on the back end from the insurance companies. We've kind of really liked that business, and then we ended up we actually found somebody who had 25 years of experience who wanted to start her own company. And we struck a deal with her to kind of run the business, where we would keep, a large a percentage of 60% of the ownership. We would fund the business and in exchange for her running it. And then we would also all share in the profits at the end of the day. And, there will be a small liquidity event at some point, I'm sure, because it is a sellable business. But in general, we're really happy because we're making money from day one. And it's a nice business where we don't have to be involved in it. So, you're right in that, if you find the right person with the money, then there's a variety of different reasons why someone will do it. And a lot of times in angel funding, an angel funder will specialize in a certain area because maybe that's the area that they really, really understand. So it might be tech, it might be medicine, it could be something else. And, they tend to specialize in an area that they know. And the golden rule in angel investing is, don't invest in something if you don't understand it. So that's probably one of the rules that goes on. And then first, you start off sometimes with family and friends, right? You kind of may start off there, and then you go to angel funding, and then maybe you go to VCs. So So now we kind of covered the basics. So let's hear from you, Chris, a little bit about the whole process and methodology of getting angel funders and working with them and those type of things. So start off. You could do a fictitious company if you want, or a real company that you worked with, and tell us about the whole process.
Well, yeah, let's work with a real one.
Okay.
Called Storyvine, and Storyvine is here in Denver. And what Storyvine does is makes it very easy for companies to develop video content that's compelling, that has a compelling story behind it, but do that automatically almost without, through a templated process rather than having to hire a videographer and like a script writer to, come up with something. So anyway, good idea. And when I met them, they were looking for their first outside funding. They had sort of V1 of their technology done. And I got involved with them through something called Rocky's Venture Club, which is an angel investment group. And I will say, this is the type of company that falls into, it certainly falls into that category of companies that may not be entirely venture fundable, but that might have a nice exit in the future for its angel investors. And there is a potential that it become venture fundable, but they haven't raised venture capital in 8 years. But at any rate, they were looking to raise money from angels. And so before I go into the details of what happened with Storyvine, let me just give you an overview of the angel investment landscape and then maybe the venture landscape very quickly. So, as I said, there are hundreds of thousands, if not millions, of angel investors. Some invest, in their buddy's company, and that's how they become. Their buddy gives them a chance to invest. They might write one check and they're done. Other guys, there's some individuals that get really interested in a particular company or a couple of companies and will write a big check and maybe get really involved with the company. There are what's called family offices, which are, to do that, you're kind of, your family is $100 million plus in net worth, maybe. I'm sort of picking that number out of a hat, but you get the point. They're really rich people, and they may have a staff of people helping to manage that money and making these investments out of that pool of capital. So think the billionaires out there, how they manage, how they would invest in angel companies, and then you've got angel groups. So probably about 20 or 25 years ago, people began to realize that angel investing can be really hard when you're just doing it by yourself, both finding the right number of companies to invest in and doing the work, the analysis and all of that. So why not team up with other people and share the work? And that's the concept of an angel group. And so there are 200 or 300 angel groups around the country. Probably every city has one or more. And it's become an industry in its own right, albeit a non-profit. The angel groups themselves are generally non-profit. They're clubs essentially, but so in like any sort of investing, angel investing should be done from a portfolio basis. The more companies you invest in, the lower your overall portfolio risk. So that means you got to do a lot of deals. You and I were talking before that, you need to do 10. Well, that's probably the minimum you need to do over the course of a couple of years. Maybe 20 or 30 would be better. That's a lot of work. So the angel groups are a way that I can invest in a company I might know absolutely nothing about, but because I trust the guy who does know something about that sector, I'll just, I'll give him a little bit of money, and then he'll give a little bit of money to my deal when I do a deal. Yeah. And that's a great way to get some additional diversification and not just be doing it blindly. And it's, from the company's point of view, it's a place where you can go. Like, one of the biggest challenges of getting angel investors is meeting them in the first place. But with an angel investment group, you don't have to worry about that. They all have websites, and you just go and apply. And there's still tricks I can talk about later. But at any rate, that's sort of the range. That's sort of the angel, a good overview of the angel market. And then venture capitalists are professionals that manage other people's money, and they range everywhere from small funds with a couple guys and maybe $5 or $6 million to manage that they'll invest in early stage companies right alongside the angel groups. Up to massive organizations that we've all heard about that, manage billions of dollars and write checks that are 20, 30, $50 million at a time. And VCs, some VCs will focus on really, really early stage companies, others only on the later stage, and then some will do the full stack. So anyway, and those guys, it's easy enough to figure out who they are, but there are challenges in terms of getting in to talk to them. So at any rate, so going back to Storyvine was a company that had aspirations to exit, still does have aspirations to exit. So they were looking for the types of angels that made those types of investments. And they came to Rocky's Venture Club, which is the angel group here in Colorado, or the biggest one, I should say. And at the time, I was new to town, but had contacts with RVC and working with my wife's uncle, who was a member of RVC, was one of their active angels, and so the two of us worked together. And I took an interest in Storyvine primarily first of all, the idea was really cool, but more importantly, the team just was. The two founders were very compelling. They're almost like yin and yang. One is very visionary, big ideas, big personality, and the other is very like, let's get stuff done. She's the COO, not surprising. He's the CEO, not surprising. Perfect combination. And having decided that we like these two people and that we like the business, we then put them through a period of due diligence. And this is where the reason I chose Stephen to tell this story was about it was almost I worked with the company as much as I worked, to help them get ready for investment as much as I did with RVC. And then that's, I think, fairly typical for someone, for a thoughtful investor would be happy to do that. And RVC certainly makes a habit of that. They have a whole educational component to what they do for entrepreneurs. But this is the methodology that I developed first with this deal, and I've told many other people thereafter, startups. And so companies, I would, hopefully this will be beneficial to your listeners. So the first thing I realized was that, the very first thing was I developed the hard way for my very first startup, and that's Saxman's number one rule of running a startup is don't run out of money. Don't run out of money. Do not run out of money. Don't even come close to running out of money. Because when you do, your business might not be dead, but you're no longer going to be in the driver's seat. So don't run out of money. And as I hinted, I learned that lesson the very hard way in my first startup. Two or three times we came very.
Yeah, it's the number one way that businesses die. It's they don't realize it, and they run out of money, and then all of a sudden they have that OSHIT moment, and they have nowhere else to turn, and they have to close the doors, and that's the number one way.
They have to close the doors, or they have to put their fates in the hands of people that are going to extract large pounds of flesh from them, which is what in our first. And you know where it really happens? I mean, because there's lots of vendors. If you're really close, there's a lot of people you can push and stiff if you have to. But where it really hurts you is with your employees, because you if you don't pay somebody for work they've done, you end up in jail. So that's or you have to let them go. At which point, then so it really, you just don't come close to that. Okay, that's my number one rule. Okay, so with that in mind, the second thing is that, again, this is for those companies that are looking to reinvest all their profits. Their investors, the last thing their investors would want is dividends. They're looking for their 10x return. Or again, it could be a relatively small business like Storyvine where they're going to sell out for $50 million and everybody be wildly ecstatic about that, as opposed to VCs would not be too excited about a $50 million exit. The next thing you have to realize is that you're going to be living off other people's money until you exit, or until you get close for a long period of time. You're going to be living off of other people's money, which means you're going to be raising money in rounds. You're going to raise angel round 1, angel round 2, angel round 3, or angel round VC round 1, VC round 2, VC round 3, etc. And therefore, when you raise a round of capital, the only job you really have is to do whatever's necessary to hit the milestones needed to raise that next round, and rinse and repeat. Because if you don't, then you violate Saxman's number one rule. You run out of money.
Right.
So you need to think about, well, okay, what is it that in my business I need to accomplish to demonstrate to people that I'm worthy of that next round, which has to be at an increase in valuation. It has to show that you've made progress towards that vision that you're pitching.
Which is, let's talk turkey here. It's about, at some point, revenue, right? That you're making some revenue. Could
be. That's not.
Or no, it could be you've gotten your product through a couple of different phases, right, of development, right?
Whatever it is. Yeah, exactly. Okay. It could be. It could be that you've gotten your first cut. That you start out and you have just an idea and some wireframes, and now it's that product you get out in your first revenue. And then once you have that first revenue, the next milestone might be that you get to, a couple $1 million in recurring revenue. If your business generates recurring revenues, it really just depends. And that's as the entrepreneur, that's your job. You need to know where you're going and what you need to accomplish.
Yeah.
This is a general rule. And so it's up to each company and each founder to understand that and have a view on that. And you might be wrong. And in fact, you often are wrong. And that's comes to the next part, which is how much money do you need to raise in, funding round, whatever you're going to raise. How much do you need to raise? Well, you need to raise enough. My friend Hugh Coleman told me that you need to raise enough to do what he would refer to as a pivot and a half. And what he means by that is, okay, I closed the round today with X number of dollars in the bank, and I can do whatever it is I think that, whatever I was planning to do for 6 months or so, discover I'm wrong, pivot the business to do something else based on what I learned while discovering the first thing was wrong. Well, what's the right thing? What did you learn from that failure? It's not a failure. I mean, that's good that okay, my first idea was wrong. Here's what I learned. This is what I think is going to work. Okay, so take a quarter or so to pivot the business, do that for 6 months, and still have money left in the bank. And then hopefully that next thing is what is successful. And then you raise money based on that. You don't want to wait until that 6 months is up because it takes time to raise that money. So you need to sort of be closing that money right around that, the end of, I guess that's month 15 in my little scenario here, right? Yeah. And you got to make sure you have a quarter of money in the bank or so, because, it's all well and good. Again, don't come close to running out of money. It might be that you've been really successful, but if the investor can look and see you have 2 weeks of cash left, guess what's going to happen to your valuation? You'll get the money. It just won't be on favorable terms. So make sure you have money in the bank so that if somebody comes with a crappy offer, you can turn that person down and go find somebody else. So you can have a couple different people bidding against each other.
Storyboard, right? Storyvine. Did they pivot?
They've pivoted several times. Yeah.
Okay.
And they're still doing the same thing, but they've pivoted. Pivoting doesn't mean you're in the, the marijuana business today, and tomorrow you're going to be in the cracker business to use two companies that are big here in Colorado. No, it just means that if you're in the marijuana business selling at retail, maybe you decide, well, actually it should be done on wholesale or something like that.
Yeah. Did they pivot in the first, did they pivot in the first 18 months from the original idea that they came about with?
No,
No,
it took them a while to pivot.
It did. Okay.
Yeah. Yeah. And, and frankly, that was one of the first couple years were, they were sort of up and down, and they had some really, some good highs, but they also had lows where they came close to running out of money. And then that, but more to the point, what we did was, so this is then okay. So now you know what you're trying to accomplish and how much money you need. How do you actually go about planning for that? Well, the way I look at it is, and this is the final piece of the story, and what I developed with Storyvine in particular, which is why I'm using them as an example. In any business at this stage, especially these types of new businesses that we're talking about here, where it's a new business model, you can't predict what your revenue is going to be. I mean, you can predict it, you can make a projection, but
they do it.
It's different than predicting with any level of accuracy. Anybody will tell you.
Yeah. And it's always a hockey stick.
Well, it's always a hockey stick. Yeah. And the hockey stick, it's always a hocky stick, right? Everybody knows that, there'll be one or two businesses that do that and most won't.
Yeah.
So in the spirit of not running out of money, you need to have what I call a cash out tool, which is really a set of projections, but I call it a tool for a very specific reason. So as not to confuse it with the projections you will need to generate for your investors that do show a hockey stick. Okay, so this is a budget, a tool, call it, that is used to manage the business and determine how much money you need to raise. Okay, and it's a living, breathing document. You should keep it up to date every week. Once you do it, you use it to manage the business, but it's an internal document. You don't necessarily need to show it to investors. You should not probably show it to investors, except for one specific purpose. All it is, okay, again, you can't predict your revenues. So no revenues other than those that are contracted that you actually can say, look, somebody signed a contract over here. They owe me that money. If that's the type of business you have, then you can put that in. I'll assume they're not going to break the contract. Okay. But what you can control in this scenario is what you spend, how much you pay yourselves, how many people you hire, what type of office you get, if you get an office, et cetera. And, so what you do is first you figure out what's the minimum you think in your estimation you need to spend to hit that milestone to raise the next round. Is it 500 grand? Okay, great. 500 grand. And that might be, you and your co-founders each getting paid $30,000 because, you can afford, you're willing to make that investment yourselves, and, hiring just the bare bones and, working literally out of your garage and all that. But you know what? That's okay. You can, in your estimation, you can hit those milestones on that bare bones budget. Okay. That becomes the minimum amount you raise. You promise investors not to take any money until you can get commitments for that minimum number, because no investor wants to be the first guy to write a check if no one else follows them, because then basically you've just wasted your money as an investor. And then you can say, well, okay, what happens if I get another couple $100,000? Would I pay myself a little bit more? Would I, get a co-working space instead of my garage? Would I hire 3 more people? All to hopefully get me to that milestone more securely with less risk. And then if you maybe raise $1 million, you can have a budget for that. And then maybe you'll say, well, okay, that's great. But if somebody wanted to give me $1.25 million, that I wouldn't take any more than that, because then I don't really know what I'd do with the money. It would be diluting my equity position as an entrepreneur. And trust me, as an entrepreneur, you're always thinking about your percent ownership of the company. And dilution is like this constant psychological tension that you have. And you're like, well, $1 million, it would just sit in the bank. There's nothing I could spend that money on beyond $1.25 million that would help me get to my goal. So I'm not going to take any more than $1.25 million. That's the maximum I'll take. And now you have a min and a max, and you can represent that to the investors. And it's a very thoughtful, reasoned way to think about how you're going to do it. And you can show them Yeah, now, and this is the one case where you will show the investors your cash out tool, and you're like, look, this is how I think the revenue is going to scale in the business. This is what I think we're going to end up doing. But here's how: if we don't raise enough money, and this is important with angels who are never going to, generally are not going to finance all 500. You're not going to get 500 grand from one person unless you're, somebody who's really wealthy. You're going to be putting together a consortium. And so that's where this scenario works really well, because it shows the investor that you understand one of their big concerns, which is financing risk, that you won't be able to get enough financing. B, it shows you're going to be really thoughtful with their money, that you're going to be a good steward of their money. And C, it shows that you're a sophisticated person. You understand how this game works.
Yeah, I've never. It's good. It's really good. I mean, because I've never seen a presentation from someone trying to raise money that actually presented it that way.
Well, if you were an investor, this would come during the one-on-one conversations. You wouldn't present that. I mean, what you might do is at the end in a slide, you might have your minimum max. Like my minimum to close is 500, and if you really think you can take up to $1.25 million, you probably wouldn't put that number out there strategically.
Yeah, it would be pretty it would show me a lot of credibility if you did do it though in the earlier conversations though. Okay. And then, I mean, do you also present at some point where you think your exit strategy is going to be too?
Yeah,
for the company.
Yeah, all investors want to see that you're thinking about that. Yeah. Absolutely, and they want to know that you want to exit. That's probably the biggest question. Is like, hey, yeah. I'm not building a lifestyle business. Yeah. And again, this is specifically for the types of angels that are looking at the next return, not the ones looking for cash flow. Because, the guys that are looking for cash flow want you to build a lifestyle business. They don't want you to sell it. They want to know that you're going to be profitable in a year, and we're all going to be, clipping coupons.
Yeah. And
that's okay too. That's perfectly acceptable. It's just different strategy.
The issue that you have is, when you talk about what you just said about the rounds, and if you add on to what I said about them talking about an exit strategy, it sounds silly, but it's a little bit it's someone who's kind of sophisticated in regards to how this whole thing works of investors and angel funding. And a lot of times you get people who are presenting to your groups or to you who, they're just, first thing is they're just trying to build a business, and they're not really that sophisticated in regards to angel funders and funding. And, that's not really on their agenda. And if they have gotten really experienced at that, it's only because they've built companies before that have had angel funding, or they've been through so many presentations that they've spoken to guys like you who say, you need to have this, this, and this. And they become much more educated and sophisticated and experienced in angel funding. Now, again, maybe angel funding, I haven't looked at angel funding deals in a good several years. So maybe the industry's gotten more sophisticated since I've been involved in it. But would you agree that it's unusual to find people who present it that way?
Oh, absolutely. Well, let's put it this way. That problem you just laid out is spot on. That is, it's one of the biggest challenges that first-time entrepreneurs have, understanding what I just said. And, I've learned this over 20 years in business.
So it's great advice for somebody who's listening right now, saying, hey, get, I mean, as much as you're going to try to understand your business and what you're going to do and how it's got to get done, you got to understand the angel funding model as well, and all these other parts of it. There's, I always got a little annoyed when I would talk to all these different people who had gotten angel funding already, and they were so much more concerned about raising more capital than they were about making the company they were working with successful. That's why it's good to have maybe 2 or 3 partners, because you can have 2 people running the business and then the other person out there raising the capital, which takes a ton of time. But when you're dealing with one person who has to do both of those things, you really question if they could be successful running a business.
Well, I've seen that too, actually. And it is a real quandary. What I'll say is that, in my observation, and this might be a little bit cynical on my part, that in certain communities, Silicon Valley, I'm looking at you.
You're looking in the right direction.
No, it's that way. Okay. That's west over there. Sorry.
Yeah.
There are so many companies out there. Are many companies who almost view their overarching goal as founders is to raise capital. The more capital they raise, the more that's a badge of honor, and the more. And these are guys that are looking at venture capital. I mean, young guys say, "Well, I really just kept raising angel capital." No. You do that first, and then you go after the big boys.
Yeah,
and you see these massive rounds, which is driven more by the fund size of the VCs than anything else. But the entrepreneurs play into it, and I think there's a culture out there.
It's celebrated by the press.
It's celebrated by the press. It's celebrated in the blogs.
It's like, hey, I've gotten my C round of funding right now, and it's like, okay, well, how's your business doing? What's the revenue like? I mean, where's the product? Where are you against really kind of making a difference?
But I had a conversation with one of the leading venture capitalists here in Colorado from a group called the Foundry Group. It's one of the guys. It's not Brad Feld. Who's their famous guy, but it was a friend of mine. This other guy was like, look, show me a business where you didn't have to, if you really want to impress me, tell me you just built a $10 million revenue business and you didn't raise any money at all. Now that I'm going to be impressed by.
Yeah.
The fact that you can raise a bunch of capital, in a market that's awash in capital is not, so what?
It shows me.
I absolutely agree with that.
Yeah, and it shows me a snake salesman. Really, it's like you keep going, and you recognize it after a while when you see someone who's raised quite a bit of capital and hasn't really produced much.
Well, conversely, I can tell you it's serious. This company I'm no longer there, but I joined when we had no funding, and just 2 founders, and we built it up to the point where and they've raised $26 million to date, and I think they're probably going to close another round here, but it's going to be a relatively small one. And have gotten to the point where we have 9 million covered lives, which means in healthcare that means that 9 million people around the country have access to a doctor through SiriusMD. That makes us number 5 in the market, behind 4 companies, 2 of which are public, one of which was just bought for a couple $2 billion, and one of which probably could be bought for a couple $1 billion. It might be. In other words, very, very big businesses. And we did that all in $26 million of capital. Okay.
Yeah.
And there are companies out there that have raised, there's one in particular that's raised almost $200 million, and they're like a fifth the size of us in terms of covered lives.
Yeah.
And so it's I think capital efficiency is a really important point in my mind. I think that's a point. The fact we did all that on $26 million is a point of pride.
Yeah.
And we still have money left in the bank too. So it's not like,
and you want to make it easy. You want to make it easy on yourself to raise money. Show the results.
Yeah.
Show the results. People be coming to your door. And then you get a better deal. The owner gets a better deal too, because people want in. You're reducing the risk.
Well, and that's exactly you just made my point for me. I mean, that when I say that you need to understand what the milestones are, what I mean is to raise the next round is that I mean that you have to know what the results are that they're going to be looking for that next round. It could be revenue, it could be percent revenue growth, that you tripled your revenue, not necessarily, it could be whatever it is, and it's, you got to be sophisticated enough to figure that out. And you probably have to talk to some potential funders. I mean, the way to do that is to say, well, okay, I've just raised this money from angels. Now I want to raise some early stage venture capital for my next round. Well, let me go talk to some of those people and say, hey, look, if I were to come to you in 18 months, what would you want my business to look like? I'll tell you. I'm like, okay, great. Let's shake hands. We'll grab a beer every 6 months or so. And then in 18 months, my business will look like that. And we'll talk about money.
Yeah. Yeah.
And do that. I mean, like literally VCs love doing that, getting to track a company for months or years on end before actually investing. They like to see that if you say you're going to do something, you actually do it. And so if you can go out and have a beer with a venture capitalist, you're not pitching him, you're just telling him about the business, you're getting to know who he is as a buddy. And you say, oh, by the way, this is what I'm looking to do. And then 6 months later, when you sit down for that next beer or coffee or whatever, you say, well, you know what? I did that. Cool. Okay.
Yeah. It's like, are you investing in the jockey or are you investing in the horse, right? That's the old adage, right? And so in this case, with the company that you were investing in with, you really liked the jockeys, right? And that's a big deal. I mean, I would, when we looked at, when I said we, me and my business partner, when we looked at maybe, I don't know, 150, 200 deals, very rarely would we say, oh, I liked that jockey. In other words, I liked the owners who are presenting. Their experience and know what they're doing. They're talking to us. They're not naive, but most of the time you have, and those are the type of people too who recognize pivoting so much easier too, because usually they're experienced. But the people who you're investing in their business idea, they sometimes have to grow into that role of being a good owner, and you don't know if that's going to happen or not, if they're going to grow into that role, but you kind of are investing in their idea. And so
no, it's so important to invest in the people. I mean, that is the adage that, the first three criteria are team, team, and team. And Storyvine is my poster child for that, because I mean, the idea was interesting, but I mean, they're 8 years in now. They still haven't broken out. They finally have got some things where they might break out. But the point is, they're still here 8 years later. And most companies that have struggles that don't break out soon after funding die.
Yeah.
But the two of them, between the way that they're really well balanced one against the other, has meant that they just keep plugging along, and they're doing fine. Some quarters they're profitable, some quarters they're not profitable, and they manage their cash flow, and all the while looking to put the pieces in place to create scalability. And like I said, we're finally getting there now.
Yeah. And just let our listeners know, I don't talk about myself that much, but the 6 companies that I've built over 25 years, none of them have had any type of angel funding, any type of investors, any type of I've never had to do that. So the idea that you come up with will dictate if it is an angel funded type of business, or it's what the term in the industry is called a quality of life business. And that a quality of life business means you're making money on the business every year, but there's, you're not going to have this big, humongous liquidity event where you had investors who are going to participate in the sale of the business, the merging of the business, at least, maybe in the beginning. Maybe down the road you pivot, or you did start off a quality of life business that turned into a better business. But and let me be clear, young people who are listening today to this podcast, I've done very well financially by reinvesting my own money, which, listen, let's be clear. I started my first company when I had $40,000 in my bank account. Okay. I was 29 years old. Okay. And I'm not going to talk about what I turned that into, but I have a very good quality of life. I have plenty for retirement and those type of things. And a lot of young people forget that that's a way to go in business. And everyone's thinking about angel funding. But the idea that you come up with will be the determinant if you are going to have to go angel funding route, because the angel funding route will allow you the time to produce the product in general. Having said that, one of the things I was curious to ask you is, what do you pay the owners during this time period? Like, if they're just starting out the business and you're giving them, $150,000 to come up with a product, do you kind of expect them to live without any income during that period?
Well, again, they get to determine what they pay themselves, right?
Right.
And
Well, you're right, but indirectly they'll say,
you get to as an investor, you decide whether you like that or not.
yeah.
That is, in my cash out tool, that's one of the key variables. What are the founders getting paid? And I think the answer to that is a thoughtful answer to that is that as an investor, you don't want your CEO or your CTO or whoever your founders are, so distracted by financial hardship that they're not able to focus on the business. If they have to go take part-time jobs working at Starbucks, for heaven's sake, because they're starving, well, that's not, or that they're so stressed out about money, that's counterproductive. So I think a thoughtful way for the investors and the founders to negotiate that is to look at what who the founders are and what's the minimum they can access, they can pay themselves.
Have you ever?
I'll tell you that it's when we did the first round for Sirius, we applied this same process I ran you all through, and Andy and I, the CEO and I, hadn't been paying ourselves anything for a year. In fact, Andy had been writing checks into the business to pay for the developers' time, which was we were both like, we need to get something here. And, we were both had kids on the way first kids on the way. And so we couldn't take nothing. We it just wasn't an option. But we basically told the investors, like, look, if we only raise that minimum amount, we're going to pay ourselves, a small amount. I won't tell you what that is.
Yeah.
But if we raise a little bit more, we're going to take some of that money and pay ourselves, because you know what, that small amount is still going to create some significant stress for us and our families. But we're going to cap our salaries. And I think we capped them at like $100,000. Okay. Yeah. No matter how much money we raised, the two of us would only take $100,000. And the third co-founder, I wasn't a co-founder, but the other co-founder wasn't taking any salary because he's a doctor and he had a salary. He was also working in the ER. He was working full-time on our business and full-time. He didn't sleep a lot, but at least he had an income. Like he wasn't under the financial concern, the strain that Andy and I would be if we didn't raise money. So that's the way to think about it.
Yeah.
On the other hand, if you got two kids that are 23 and they're like, we're bunking together and we got 5 other roommates and we're happy to eat ramen and I don't need money. I got a little bit saved up and I spend $20,000 a year. Okay, well then that's the answer there. Yeah. It's really that. This isn't about this. Just needs to be grounded in reality.
Yeah, yeah.
Just grounded in common sense.
Yeah. Listen, that we could be talking about this all day long. It's a good topic, and I know you have so much more to say. Do you blog about this stuff at all?
No, I don't.
You should. I mean, I know you have that Medium that you write on that. Sure, you should. Do.
Maybe I will, but right now I'm focused more on the healthcare innovation part of things. What I'll say though is, you're absolutely right. This would be something I could definitely blog on. But the good news is that there are people that are way more experienced in this than even I am that do blog about this.
Yeah, there's a lot of information out there.
There's a lot of information.
I know.
Going back to your point about how do young entrepreneurs or first-time entrepreneurs learn about this stuff? Well, there are a lot of angel groups will have educational seminars. RBC does a lot of that. They have a whole thing called the Hyper Accelerator that companies spend a week going through. They pay a little bit of money
That's
for it,
great.
like $1,000 or something. But it's like an intense week getting you ready to pitch for angels. And the people that teach you are all the angels themselves. And they come in and volunteer their time to help out the companies. New York Angels, the group they do pitch training, they do a bunch of stuff. So and then there's books, like that guy David Rose you and I talked about. He wrote a book about angel investing. I think it's Angel Investing for Dummies. It's one of those dummy books. People should get those things. There are a couple of VCs I'll mention that are really good that I turn to all the time when I want to know a specific thing about the venture market. And I'll touch on all kinds of startup things. One is Fred Wilson. His blog is AVC, just those three letters.com, AVC. Another guy is Brad Feld here in Boulder. And I think his is feldthoughts.com, FELD thoughts.com. And they're both, they've got years of blog post archive and you can search. So those two blogs between the two of them are just great sources of intelligence. First Round Capital, a venture capital firm that focuses well on first rounds for early stage investors, also has a lot of material on their website. So there's a lot of good content out there.
Yeah. So I'm going to ask you on air, Chris, to watch out for something for me.
Okay.
And I'll also tell our listeners too, as well. If you do, Chris, or any of our listeners come across a business, whether the idea is not a angel funded type of business, that's more of a quality of life business, and they're looking for a partner like an investor to help them with the funding and how to run a business. I know me and my business partner would be very interested in that. So, we would provide the capital. So like what would be the perfect scenario would be somebody who's, spent a lot of time in an industry already and wants to go out on their own and wants to start a business in something that they really, really know already. It wouldn't be angel funding opportunity potentially. But it might be a service business, right? Mm-hmm. Mostly angel funded businesses are product businesses, mostly. Mostly, yeah. Not always. It's changed a lot.
Service, but they're scalable. But at the end of the day, the difference between a lifestyle business or a quality life business and age is it scalable or not?
Yeah, yeah.
And there's no right answer. Both are incredibly worthwhile pursuits, by the way.
Yeah, I agree. They both have their warts, believe me. Yeah, I think more angel funding than more warts than anything else. I mean, everyone when they're younger thinks that they want to be worth 30, 40, 50, 100, 200 million dollars, and that's a challenging path. There's a lot of people who want to do.
For everybody who accomplishes even a tenth of that, there are 1,000 people that don't accomplish anything that try.
Yeah.
You never hear about them.
Yeah.
Trust me. But keep going.
Yeah. So, I mean, if you do come across any deals like that and someone, we would love to talk to them.
Well, Steve, yeah, absolutely. And let me ask you, tell me a little bit more about the type of financing that you might offer so I can, look for the businesses that would offer where that would make sense. And from time to time, I do actually see companies like that. So yeah, just tell me more.
Well, I mean, there's financing solutions that I do now is completely different from what I'm talking about. That's, that we provide lines of credit to businesses and, that's what we do. We provide short-term emergency cash flow and you have a line, just like a line of credit from a bank, we provide that. It's a really good plan. I mean, if I was, 15 years ago, I had a line of credit with a bank and I had this one particular scenario where we were just doing great. We're on the Inc. 500 fastest growing companies in the United States. And my line of credit, my team was just going out and selling like crazy. And I didn't recognize that I didn't have enough in my line. I knew in 3 or 4 months I was going to have to go back in my bank and ask them for more money. And but they kept selling like crazy. And I was going to be $20,000 short on payroll. And went back to my bank. I said, I'm going to be $20,000 short. I need the money. And they were like, okay, we'll let you know in about a month and a half. It's like, that
Yeah,
doesn't help me. Right. That's where I come in. My company Financing Solutions, that's a little bit different scenario, but but our clients typically use the money for a very short period of time of what we're talking about. It's a great deal because it's easy to get in place, doesn't cost anything to get in place and keep it in place. They use it for short periods of time, they pay it back, so on and so forth. So Financing Solutions is completely different. But the deal I have with the other company that we own called Elite Funeral Funding, which is, again, we buy life insurance policies when someone passes away, because what happens is a family has to wait 60 days for them to get paid, usually from the insurance company, and they need the money. They typically need the money for the insurance, for the funeral, which could be, $10, $15, $20,000. And so, in this case, to answer your question, so the deal we have with the owners of that company is we provide the funding. We charge them an X amount of money for how much money that they have outstanding with us, and it's a reasonable interest rate. And then again, on the back end, we help them build this company. What was amazing that me and my business partner, between both of us, we've built 8 companies, and every single one of them has been successful. So, and what I define that by successful is that they've all made money. And so they've done really well. Now, my business partner had a very big exit. He sold his company. It was a good company. And, but when we built Elite Funeral Funding, because my business partner and I had built 8 companies, I would just tell you that we had the company up and running and profitable within 6 months. Whereas I think if we had done it when we were in our 20s, right, it would have been 3 to 5 years. We knew all the steps. Okay, what accounting packages are we going to use? What type of CRM system? What's our lead generation system? What's our clients look like? What type of staff do we know? What's our cash flow analysis? We knew everything. And we had that thing up and running with really great partners that are running the business so fast, but they had no business experience as far as building any companies. So everything we had to teach them that they just knew the industry that they were in. So that's a typical example where, we can kind of provide both those things where we're really involved, and we're not, that's not like a business that's going to have a big exit strategy. It's going to probably sell at some time, but probably we will sell it back to the owners, honestly, our other partners at some point, and go from there. So yeah, that's a typical. So, well, listen, that's been a great conversation. And Chris, I really appreciate you coming on to talk to us. I'd like to thank you so very much. And if you like today's podcast, please feel free for our listeners to share it with a friend, and also subscribe on your favorite podcasting app. And of course, if you're looking for a line of credit for your business, you can call us at 862-207-4118, or visit our website at fscreditline.com. Again, fscreditline.com. And again, if you have a business that you think that I just mentioned about, that you think you might want a investor in, that's not angel funding type of scenario, then give me a call at 862-207-4418. Chris, if anybody wants to get in touch with you, how would they reach you?
Well, you can either contact me on LinkedIn, Chris Saxman, Denver, Colorado, Denver area, or my email is mcsaxman, SAXMAN, @gmail.com.
Yeah, and although that also be in the notes from today's podcast as well, so you can reach Chris through that too as well. If you're a listener or interested in getting any new business ideas, or business ideas in general, I tweet daily about lessons that I've learned over 20 years of starting my own companies. I tweet at Halasnik, SHALASNIK. And just for our listeners, just remember, today in summary, it's the idea. It's your business that determines if you need to go the angel funding route. And hopefully you learned a lot today. And Chris, thanks for coming on board.
Well, thank you so much for having me. I had a great time. It was enjoyable talking about this, and I'm happy to talk with other people more in depth if so desired. Thank you very
Sounds
much.
good. Good. Everybody have a great day. Everybody, please stay safe.